It is the great paradox of Wall Street that a place of such bewildering complexity, a whirlwind of tickers, charts, and arcane financial instruments, has produced its greatest and most enduring fortunes through the application of a few shockingly simple principles. The public is often led to believe that success in this arena is the domain of geniuses with access to secret information or reckless gamblers blessed with impossible luck. They are taught that to win, one must be faster, more cunning, and more complicated than the next man. What if this is a profound illusion? What if the most successful investor of the modern era, a man who has compounded a small stake into a colossal empire, built his entire philosophy on rules so fundamental, so deeply rooted in common sense, that their echoes can be heard in the very corridors of Wall Street a century ago? These are not secrets. They are disciplines, and today we shall uncover the first of them. The foundational rule, repeated by Warren Buffett with the conviction of a religious creed, is a two-part mandate. Rule number 1, never lose money. Rule number 2, never forget rule number 1. The novice hears this and scoffs, thinking it an impossible, even absurd standard. Does not the market fluctuate? Do not even the best stocks suffer declines? But this is a shallow interpretation. The rule does not speak of avoiding the temporary paper losses that come with the natural ebb and flow of market sentiment. It speaks of the one unforgivable sin in capital management, the permanent loss of capital. This is the loss from which there is no recovery, the kind of loss that removes you from the game entirely. It is the loss incurred by buying a fraudulent enterprise that goes to zero, by paying a ludicrous price for a popular stock at the peak of a bubble, or by using so much borrowed money that a minor downturn forces a catastrophic complete liquidation. To never lose money in this sense is not a command to be timid. It is a command to be prudent, to prioritize the preservation of your capital above all else, for it is the seed from which all future fortunes must grow. This mentality is not new. It is the very essence of the old veterans of the street, those weathered figures who built dynasties through the panics and squalls that ruined lesser men. They understood that the bulk of their returns would not be made in the frothy, optimistic days of a bull market. Their greatest profits would come from deploying capital in the darkest hours of a panic. Therefore, their primary objective during times of prosperity was not reckless gain, but the diligent preservation and accumulation of cash. Their guiding principle was to avoid any venture that carried the risk of a permanent impairment of their capital. They avoided the fancies, the popular but flimsy stocks of the day that soared on rumor and crashed on reality. They avoided debt. They understood that losing 50% of one's capital requires a 100% gain just to get back to the starting point, a ruinous mathematical handicap. By adhering to this first great rule, they ensured that when the inevitable storm arrived, they were not the ones being washed away. Instead, they were the ones standing on the shore, cash in hand, ready to purchase the finest properties from the wreckage at a fraction of their true worth. The modern application is identical. It means having the discipline to walk away from the speculative manias of the day, whether they be in technology stocks with no earnings or in complex financial products of dubious value. It means refusing to invest in a business whose balance sheet is laden with debt. It is the discipline to avoid playing a game where the odds of a permanent catastrophic loss are unacceptably high. This leads directly to the second great rule, which is the practical mechanism for obeying the first. Invest only in what you understand. Buffett refers to this as defining your circle of competence. The size of that circle is not important. Knowing its boundaries, however, is vital. This is not a call for universal expertise. It is a demand for intellectual honesty. It is the admission that you do not need to have an opinion on every company or every industry. You only need to have a deeply informed opinion on a select few. The greatest investment mistakes are made when one ventures outside this circle, lured by the promise of quick profits in a field one does not comprehend. History is a graveyard of fortunes lost by men who violated this principle. In the 19th century, Wall Street was littered with the ruins of those who, having made money in mercantile trade or farming, believed they could master the complexities of railroad finance overnight. They were drawn in by hot tips about new lines being built to nowhere in particular, and their capital was consumed by enterprises they could not possibly evaluate. The great James R. Keene, a man of unquestionable genius, provides a tragic and instructive example. Keene was a master of mining stocks on the West Coast. In that arena, his knowledge was profound, his success legendary. He amassed millions by understanding the geology, the management, and the market sentiment of the Comstock lode better than anyone. But in an evil hour, flushed with success, he was induced to spread himself out all over creation. He began to speculate in everything that came along, in wheat, in lard, in opium. He attempted to corner the entire grain supply of the country, a business whose global dynamics and weather-driven uncertainties were entirely outside his circle of competence. The very week his famous horse, Foxhole, won the Grand Prix in Paris, Keene himself was disastrously beaten in the speculative race by the steady farmers of the West, who sent their wheat to market faster than his $13 million could absorb it. His fortune, built on mastery in one field, was destroyed by hubris in another. For the first-time investor, the lesson is not to be intimidated, but to be focused. You do not need to be an expert in biotechnology or semiconductor design to be a successful investor. Start with what you know. If you are a banker, you have a better understanding of the banking business than 99% of market participants. If you are a retailer, you understand merchandising and consumer trends. If you are a doctor, you have insight into the healthcare industry. Begin your analysis there. Study the companies whose products you use, whose stores you frequent, whose services are a part of your daily life. Is the business simple and understandable? Can you, in a few sentences, explain how it makes money? If not, move on. There are thousands of publicly traded companies. You only need to find a few good ones that lie squarely within the circle of what you can, with reasonable effort, understand. The goal is not to be a jack of all trades, but a master of a select few. The third rule provides the essential shift in mindset that underpins this entire philosophy. When you buy a stock, you are buying a business. You are not purchasing a flickering symbol on a screen, a lottery ticket whose value is determined by the whims of the crowd. You are acquiring a fractional ownership of a real operating enterprise. You are a silent partner in a business with physical assets, employees, customers, and a stream of earnings. This perspective changes everything. It forces you to ask the questions a prudent businessman would ask before buying a company outright. Is the business profitable? Does it have a long history of consistent earnings? Does it have a strong financial position? Is it run by honest and competent managers? Does it have favorable long-term prospects? The speculators of old who failed were those who treated stocks as mere gambling chips. The men who built enduring fortunes, however, thought like proprietors. When Commodore Vanderbilt acquired control of the Harlem Railroad, he was not merely speculating on its stock price. He was buying a tangible business, an asset he intended to improve. He put his own money into the road, laid a double track, and through his own exertions, turned a property whose stock had sold for a few dollars a share into one of the most valuable in the country. He thought as an owner, not a trader. When you adopt this mindset, the daily fluctuations of the market become largely irrelevant. You will not be tempted to sell a wonderful business just because its stock price has dropped 10% on some baseless rumor. And you will not be tempted to buy a mediocre business just because its stock price is rising. Your focus will be on the long-term earning power of the underlying enterprise. But how does one learn to think like these great business owners? How can one truly grasp the motives and methods of the titans who built corporate America? While one can learn from modern masters, the timeless lessons from the very formation of Wall Street are captured in one indispensable work. The new, complete 2-volume edition of 50 Years in Wall Street is not a mere memoir, It is a definitive guide to the psychology of wealth and power. Across its 1,000 pages of original unabridged text by Henry Clews, you gain an insider's access to the inner workings of the markets, witnessing the rises and falls of giants like Drew, Gould, and Vanderbilt through the eyes of a contemporary. You learn not only their strategies, but their character, their audacity, their cunning, and their fatal flaws. This edition, complete with all the original photographs, is your opportunity to understand the very DNA of American capitalism. It is an essential acquisition for any serious investor who seeks to understand not only what to buy, but why. The link to this comprehensive guide can be found in the description of this video. This ownership mentality is the anchor that will hold you steady in the turbulent seas of the stock market, allowing you to build wealth by partnering with great businesses, rather than losing it by gambling on fleeting prices. Once you have adopted the mindset of a business owner and disciplined yourself to stay within your circle of competence, the next task is to identify the truly superior enterprises. Not all businesses are created equal. Many toil in brutally competitive industries where profits are fleeting and survival is a constant struggle. The truly great businesses, the ones that create lasting wealth for their owners, are different. They are protected. They are fortresses. This brings us to the fourth rule, a concept central to the Buffett philosophy. Always seek a business with a durable competitive advantage, an economic moat. An economic moat is a protective barrier that shields a company from competition, allowing it to earn high returns on capital for many years. Think of a medieval castle surrounded by a wide, deep moat filled with crocodiles. That castle is the company's profitability. The moat is its competitive advantage. The wider and more treacherous the moat, the more difficult it is for invading armies, competitors to breach the walls and plunder the treasure. This moat can take many forms. Sometimes it is a powerful brand, an idea so deeply embedded in the consumer's mind that it commands loyalty and pricing power. It can be a low-cost advantage, where a company's scale or efficiency allows it to produce its goods or services far more cheaply than anyone else. It might be a government patent, granting a temporary but powerful monopoly. Or in the modern age, it can be a network effect where a service becomes more valuable to each user as more people join it, creating an almost insurmountable barrier to entry for newcomers. This idea of building an impregnable business fortress is as old as capitalism itself. Consider the methods of Commodore Vanderbilt in the mid-19th century. When he gained control of the New York Central Railroad, he did not simply operate it. He began a relentless campaign of consolidation. He acquired the Hudson River Railroad and other competing lines, not merely to expand, but to dominate. He was not just building a railroad, he was building an economic fortress. He understood that control over the essential transportation corridor into the financial heart of the nation, New York City, was a prize beyond measure. By unifying these lines under one management, he created a system so powerful, so efficient, and so strategically vital that it rendered effective competition nearly impossible. He had dug a wide and deep moat around his enterprise. Any potential rival would have to spend a colossal fortune to even attempt to replicate his network, a risk few were willing to take. He controlled the gateway, and for decades, all who wished to pass had to pay his toll. The modern investor seeks the same dynamic. Companies like Coca-Cola possess a brand moat. Its name is a global synonym for refreshment, a psychological advantage built over a century that no competitor can easily replicate. Amazon possesses a logistical and network effect moat. Its vast network of warehouses and its marketplace of millions of buyers and sellers create an ecosystem that is extraordinarily difficult to challenge. Google possesses a moat of technological dominance in search, an advantage that feeds on itself with every query typed into its search bar. The successful investor learns to identify these moats, for they are the single greatest indicator of a business's long-term durability and profitability. However, owning a piece of a great business is only half the equation. The price you pay is the other, equally critical, half. This leads to the fifth and perhaps most practical rule of all: buy at a wonderful price with a margin of safety. This is the core of value investing, the discipline taught to Buffett by his mentor Benjamin Graham. The concept of a margin of safety is simple but profound. You must purchase an asset for a price significantly below your conservative estimate of its intrinsic value. This gap between the price paid and the underlying value is your margin of safety. It is your protection against the uncertainties of the future, against errors in your own judgment, and against the unpredictable swings of the market. It is the shock absorber that turns a potential mistake into a minor inconvenience, and a sound judgment into a spectacular success. This principle is the very strategy that the old veterans of Wall Street employed with such devastating effectiveness. They understood that the widest margin of safety is created in the crucible of a market panic. When fear reaches its zenith, when the public is selling indiscriminately in a desperate flight to cash, the prices of even the finest enterprises become detached from their fundamental worth. That is when the gap between price and value becomes a chasm. Consider the panic of 1857. In the wake of the Ohio Life and Trust Company's failure, securities of all kinds were thrown overboard without regard to their merit. Stocks like Michigan Southern, a vital railroad of its time, collapsed to as low as $3 or $5 per share. For the speculator caught in the storm, it was ruin. But for the veteran who understood the railroad's tangible assets, its miles of track, its locomotives, its real estate, and who had the cash and the courage to act, the margin of safety was immense. He was buying a dollar's worth of assets for a dime. When sanity inevitably returned to the market and the stock recovered, his profits were not the result of a lucky guess, but the logical outcome of a disciplined strategy. He had bought a great business at a wonderful price. The first-time investor must learn this lesson above all others. You make your money not when you sell, but when you buy. The price you pay determines your ultimate return and, more importantly, your margin of safety. This analytical framework culminates in the sixth rule, the psychological engine that drives the entire process. Be fearful when others are greedy, and greedy when others are fearful. This is the most famous of Buffett's aphorisms, and it is nothing less than the distilled wisdom of every great market operator who has ever lived. It is the practical application of the margin of safety principle, and the precise mirror image of the behavior of the losing crowd. It is the discipline to sell or stand aside when speculation is rampant and prices are absurd, and the courage to buy aggressively when pessimism is universal and bargains abound. Let us first examine the condition of fear. The great panics of history provide the most vivid illustrations. Consider the events of Black Friday, September 24, 1869. A conspiracy to corner the gold market had driven the premium to dizzying heights, reaching 162. The market was a scene of pandemonium, a bedlam let loose. Then at noon, the government announced it would sell gold. The corner was broken. In a matter of minutes, the price collapsed, plummeting from 162 to 132. A state of chaos reigned. Fortunes were wiped out in the time it took for the ticker to report the new price. The crowd was consumed by a terror so profound that it led to the suspension of the gold board itself. This is the face of fear. In such moments, the only thought of the average man is to sell, to escape, to salvage whatever he can from the wreckage. But it is in these very moments of maximum fear that the greatest opportunities are born. The veteran is not selling. He is calmly assessing the damage, identifying the sound assets being sacrificed, and beginning to buy. He is acting on the principle that the best time to acquire a valuable asset is when no one else wants it. He is being greedy, precisely because everyone else is being fearful. Now let us examine the opposite and equally dangerous emotion, greed. Periods of wild, unreasoning speculation offer a stark contrast. The boom that swept Wall Street in 1901 is a perfect example. Spurred by a wave of industrial consolidations and trust formations, A speculative mania seized the nation. The public, intoxicated by stories of quick fortunes, became crazy to buy. New corporations, capitalized at many times their real value, were floated on the market, and their stocks were eagerly devoured by a public that had lost all sense of prudence. Transactions on the stock exchange reached volumes never before seen. One stock was considered about as good as another, as all were going up. This is the face of greed. In such moments, the average man is mortgaging his house to buy stocks on margin, convinced that prices can only go higher. He has forgotten that trees do not grow to the sky, but it is in these moments of maximum greed that the greatest risks are born. The veteran operator is not buying. He is looking at the absurd valuations and growing fearful. He may be selling his holdings to the euphoric crowd, taking his profits and converting them to cash. Or he may simply be standing aside, patiently waiting, knowing that a market driven by greed rather than value is a precarious structure, destined to collapse. This contrarian discipline, to act as a buyer when the world is selling in a panic, and a seller when the world is buying in a frenzy, is perhaps the most difficult of all to master, for it requires one to act against the most powerful of human instincts. But it is the very quality that separates the enduring fortunes from the fleeting ones, the master from the crowd. Having laid the analytical foundation for identifying a superior business and the opportune moment to purchase it, we arrive at the discipline required to see the investment through to a successful conclusion. This is a matter of temperament and philosophy, and it is here that most aspiring investors fail. They may possess the intellect to analyze a balance sheet, but they lack the fortitude to withstand the market's psychological pressures. This brings us to the seventh rule, a principle that separates true investing from mere speculation. Invest for the long term. As Buffett has stated, if you are not willing to own a stock for 10 years, don't even think about owning it for 10 minutes. This philosophy represents a radical departure from the common perception of Wall Street. To the outside world, and indeed to a great many of its participants, the market is a place of frenetic activity, of buying on a rising rumor and selling on a falling one. It is a game of quick turns, of capturing small profits, of constantly being in motion. Buffett's approach is the antithesis of this. He views the purchase of a stock not as a short-term trade, but as a permanent partnership with a business. His goal is not to play the market or outguess its next move. His goal is to own a fractional share of a wonderful business that will compound its value year after year, decade after decade. He is a proprietor, not a trader. He buys with the intention of holding indefinitely, as long as the underlying business continues to meet his high standards of profitability and management. This long-term perspective is a powerful antidote to the feverish activity and nervous strain that have always characterized the speculative class. Henry Clews, in his 50 years of observation, saw countless operators who were consumed by the daily battle with the ticker tape. They were constantly changing their holdings, shifting from the bull to the bear side, driven by every rumor and fluctuation. One such figure was Henry N. Smith, a man of considerable natural ability who ultimately met with disaster. Smith, after a period of success, became what Clews described as a chronic bear. He became possessed by a single idea, that the market was destined to fall. He fought the market with desperation on every advance. During the great bull market of 1885, while values were constantly rising, Smith adhered steadily to his policy of attacking prices. When his own money was exhausted, he began to incur cumulative liabilities until his losses became so great that they not only consumed his entire fortune of over $1 million, but dragged down the firm of William Heath and Company with him. He was a man fighting the tide, a man so focused on the short-term waves that he was oblivious to the powerful incoming current of prosperity. He was a speculator, constantly reacting, and ultimately, he was broken. The long-term investor, by contrast, positions himself to ride that powerful current. He understands that the true source of wealth in the stock market is not from correctly predicting short-term price movements, but from the power of compound interest. This force, which Einstein is said to have called the eighth wonder of the world, is the process by which a business's earnings are reinvested to generate even more earnings, creating a snowball effect of wealth creation. This process is not dramatic. It is slow, methodical, and often quite boring. It does not produce thrilling stories for the newspapers. But its results over a decade or two are nothing short of miraculous. By adopting a long-term holding period, the investor allows this incredible force to work its magic on his behalf. He insulates himself from the psychological pressure to act on every piece of news, to join every stampede. He understands that most of the market's daily chatter is, in the grand scheme of things, meaningless noise. His focus is not on the next quarter, but on the next decade. This patient, long-term approach is the cornerstone of building truly substantial and lasting wealth. This philosophy of ignoring the non-essential leads directly to the eighth rule, a discipline that requires the shutting out of a veritable army of distractions. Ignore market forecasts and short-term noise. Buffett is famously dismissive of the entire industry of market prediction. He has noted that the only value of stock forecasters is to make fortune tellers look good. He pays no attention to the pronouncements of economists about where the economy is headed, nor to the price targets set by Wall Street analysts, nor to the confident predictions of market gurus on television. He understands that the future is fundamentally unknowable, and that any attempt to predict the short-term movements of the stock market is an exercise in futility. The market is a complex adaptive system influenced by millions of participants, each with their own fears, hopes, and motivations. To believe one can consistently predict the collective mood of this crowd is the height of arrogance. This is a lesson that every generation of speculators has had to learn, often at great cost. Henry Clews warned constantly against the delusive rumors and manufactured points that are the daily currency of the street. The heedless credulity of the dupes, he wrote, is matched only by the deliberate lies of the canard makers. He described how, on the basis of some sensational rumor, wild scenes of excitement and consternation were witnessed in Wall Street, and fortunes were lost in the ensuing chaos. The wise investor, whether in the 19th century or the 21st, understands that this noise is not designed to inform him, but to provoke him into action. Action generates commissions for brokers and provides liquidity for large operators to unload their positions. The small investor who acts on this noise is almost always the last to hear it, and his buying or selling merely serves the interests of those who originated the rumor. The true investor learns to cultivate a profound sense of detachment from this daily drama. He knows that the financial news of the day is overwhelmingly focused on short-term price movements and the endless speculation about what might happen tomorrow. His focus instead is on the actual business results of the companies he owns. Are earnings growing? Are profit margins stable? Is the company strengthening its competitive position? These are the questions that matter. The day-to-day price of the stock is merely the momentary and often irrational opinion of the crowd. The business value is the underlying reality. Over time, the price will inevitably gravitate toward the value. By focusing on the business and ignoring the noise, the investor aligns himself with the powerful long-term trend of value creation rather than being whipsawed by the fleeting and treacherous currents of market sentiment. This brings us to the final and perhaps most important rule of all, the one that serves as the engine for all the others. Read. A lot. How does one develop a circle of competence? How does one identify a durable economic moat? How does one calculate the intrinsic value of a business to determine a margin of safety? The answer is not found in a secret formula or a mystical insight. It is found in the patient, diligent, and relentless accumulation of knowledge. Buffett has famously stated that he spends the majority of his day, even now, simply reading. He reads annual reports, trade journals, newspapers, and books. He is a learning machine, constantly feeding his mind with information about businesses, industries, and the way the world works. He is not looking for a tip. He is looking for an education. He is seeking to build a broad base of knowledge that will allow him to make intelligent decisions when an opportunity presents itself. This dedication to intellectual rigor is the great, unglamorous secret of all true investment success. It is a direct refutation of the idea that Wall Street is a place for gamblers. Gambling is a surrender to chance. True investing is the process of reducing chance and maximizing the probability of success through superior knowledge. This echoes the core belief of the most astute operators of the past. Henry Clews insisted that the business of Wall Street requires long and close training in financial affairs, and that a successful financier must be an unceasing and intelligent observer of events at large. Success in this field comes not to the man who is most daring, but to the man who is best informed. It is an intellectual pursuit of the highest order. The man who is unwilling to do the work, to read the reports, to study the industries, to think critically about the future, has no business being in the market. He is simply a lamb waiting to be sheared. The price of success is the hard, solitary work of study. There are no shortcuts. In the end, these 9 rules are not a complex algorithm for beating the market. They are a simple but not easy philosophy for building wealth. They are a philosophy of character. They demand the patience to wait, sometimes for years, for the perfect pitch, the wonderful business at a wonderful price. They demand the discipline to stay within your circle of competence, to admit what you do not know, and to resist the siren song of easy profits in unfamiliar territory. And above all, they demand the independent thought and emotional fortitude to act against the crowd, to be greedy when others are fearful and fearful when others are greedy.